we come to Chris's address. Chris, as you will have seen from the invitation, has a distinguished record of working in developing countries overseas and in finance. And I was delighted to see he came from Wales. And earlier this evening, talking, his illustrious name is associated with another Schumacher, Gus Schumacher, who was small, is beautiful, etc. So anyway, enough of that. So Chris, would you like to give us your lecture and tell us a bit about AgDevCo as well?
Good afternoon, everyone. When war came to northern Ethiopia in 2021, Ethio Chicken's employees in the city of Mekelle, who had not been paid in months because of all communications with Addis Ababa and the wider world were down, formed a human barricade to protect the poultry company's hatchery from looting. Now, why would they do that? Perhaps because the company had created 230 good quality jobs and had been selling improved breeds of free-range chickens to many thousands of rural households in the area, supporting livelihoods and improving nutrition. A few months later, when a peace agreement was reached, Ethio Chicken was able to restart its operations in Mekelle. All its employees were safe, thankfully, and they received full back pay. This is sustainability. A profitable and growing company, a responsible employer fully embedded in its community with a business model that benefits rural households and is resilient even in the most challenging of circumstances. The slides will shift. Does someone have the ability to change the slide, please? Ethio Chicken, here we go, is part of the Hatch Africa group, which with AgDevCo's support has now expanded into 6 African countries. And last year, Hatch sold free-range chickens to 4.6 million smallholder households across Africa through a network of more than 10,000 freelance agents linked across its digital platform. That's impact at scale. My name is Chris Isaac from AgDevCo. It's a real honor to be giving this 41st Ralph Melville lecture, sponsored by TAAI, whose mission is to advance knowledge, understanding, and practice in agriculture, which is sustainable, resilient, equitable, and empowering. AgDevCo's mission is to invest in sustainable agriculture in Africa. So sustainable agriculture means many things, environmental, social, but I would emphasize one key dimension. It needs to be profitable, or quite simply, any benefits will not be sustained for the long term. There are many well-intended agriculture projects supported by governments and NGOs which don't endure once the grant funds come to an end. Irrigation schemes are not maintained, or agricultural produce goes to waste because there are no reliable links to markets. One example we're familiar with in northern Malawi, NGOs encouraged farmers over many years to plant macadamia. Malawi has a fantastic climate for macadamias, perfect soils, they grow very well. The result of that program was that farmers were accumulating piles of macadamia nuts in their homesteads. They had no market for the nuts. So, next slide. Back one. More importantly, when agriculture is profitable, it has the potential to be scalable. And if we want to make more progress on the Sustainable Development Goals, the SDGs, including the ambition of ending all forms of poverty everywhere, which is SDG 1 by 2030, scale is essential. A collection of projects that deliver improvements for only a few hundred or 1,000 people at a time are not going to close the gap. As you can see on the chart, globally, there are about 600 million people in extreme poverty today. The World Bank forecasts that extreme poverty will largely have been eradicated in Latin America and Asia by 2030, but sub-Saharan Africa will still be at around 500 million, or a third of the continent's population. And the majority of those people live in rural areas and rely on subsistence farming. Now, decades of aid have not fundamentally changed this picture. There have been improvements in health and education, but there's been little in the way of economic transformation in rural areas in countries like Malawi, Mozambique, or Zambia. Without jobs and incomes, rural poverty and food insecurity remain stubbornly high. And this is not just about altruism, of course. Ellen Johnson Sirleaf, the former president of Liberia, was speaking at an impact investing conference in Oxford a few years ago, where she described the urgent challenge of creating jobs for young people. About 10 million African youth will enter the labor market every year in the coming years, and yet only 3 million jobs are being created each year. And as Sirleaf pointed out, if we don't find a way of meeting the expectations of a rapidly growing youth population, we can expect to see major social pressures and increased migration. So in this talk, I'll make the positive case for the role of the private sector in agriculture to help develop commercially viable farming and agri-processing businesses, which is perhaps the best way to create jobs and wealth in rural areas. I'll argue 4 points. Firstly, as we heard from Andrew, agriculture is a business at any scale, whether you're a smallholder farmer or a large commercial plantation, and any business has to be profitable. Secondly, responsibly managed, medium-sized agribusinesses, which are embedded in their communities, can create wealth in rural areas. More importantly, the very best examples can kickstart new industries. Thirdly, agriculture is too important to be left to market forces alone. Far too little private investment goes to agriculture in the low-income countries today. The risks are considered too high and the returns just too low. Without some level of public subsidy, there will be too little investment. And finally, that brings us to blended finance, which combines aid and investment in innovative ways. It offers a solution. There is a strong rationale for subsidizing investment in early-stage agriculture companies. Using aid in this way can be exceptionally good value for money. So how I came to impact investing. I did grow up in Wales on a small hill farm, a son of parents who were influenced by the self-sufficiency movement of the 1970s, and the grandson of a well-known development economist, E.F. Schumacher, author of the book Small is Beautiful. The farm, and that's a picture of me, my younger sister, which was on the edge of the Brecon Beacons, was certainly beautiful, but Welsh hill farming then, as today, was not profitable. It relied on subsidies, which just about allowed farmers to keep their heads above water. Influenced by my grandfather, I studied economics at university, and then after a few years working for a large accountancy firm, I went to the Ministry of Finance in Namibia as an ODI fellow. So it all started here. Well, I think ODI is in a different building from my interview back in the year 2000. Part of my job involved reviewing applications from startup firms for government guarantees. The first was for a toilet paper factory. So you could say my career in impact investing started on a roll. My family did warn me about that one. Got away with it. A few years later, after a short stint with the UK's Department for International Development, I met Keith Palmer. Now, Sir Keith, recently knighted for services to international development, a former investment banker, also, as it happens, born and bred in South Wales. Frustrated by what he saw as the limited impact of traditional aid, Keith had been working with the UK aid programme to set up the Private Infrastructure Development Group, which has to date mobilized $25 billion from the private sector into lower income countries for infrastructure projects. I went to work for Keith in the late 2000s, expecting to be financing power and sanitation projects. But in the first few days, he said he wanted to set up an agriculture development company. And with £50,000 of Keith's own money as a philanthropic contribution, we started AgDevCo in 2009. 15 years later, AgDevCo has 50 staff, an investment portfolio now invested of over 230 million into 38 agriculture companies across 11 African countries. We've raised funding from 3 development finance institutions now, British International Investment, the UK DFI, Norfund, and the US's Development Finance Corporation. And we're looking forward to welcoming some new investors soon. We're proud that over 80% of our portfolio is in the least developed countries, and about half of our investees focus on local and regional markets, contributing to food security. We also support export businesses growing and processing crops like avocados, cashews, bananas, macadamia. As we've seen, extreme poverty is increasingly concentrated in rural Africa, where the majority of the population engages in subsistence farming. It's widely recognized that investment in agriculture is more effective than investment in any other sector to address poverty. As this quote from a paper from DFID in 2015 says, I'll read it out. Agriculture sector growth, where it can be achieved cost effectively, is likely to have a bigger impact on poverty reduction than growth in other sectors, as it offers the most direct route of raising returns to poor people's main assets, land and labor. But if there is a consensus about the need for more investment in African agriculture, there is less agreement about what type of agriculture should be supported. And there is still often a divide between those who say that smallholder farmers should be the exclusive focus and those who promote modernization and structural change. A case perhaps of small is beautiful versus big is better. We don't think this polarization is helpful. There is a sensible middle path. Responsible medium-sized companies embedded in their communities with inclusive business models can combine the best of both worlds. They can support large numbers of jobs, they can buy raw materials from smallholder farmers, they can add value to commodities, and they can link to regional and export markets. They can grow over time into truly world-class operations, often adopting new farming practices and technology that put them ahead of any competitors in the rest of the world. And I'll just briefly speak to 3 examples from AgDevCo's portfolio. As many of you may know, Côte d'Ivoire is the largest producer of cashew nuts in the world. You will all have eaten cashews from Côte d'Ivoire, but you may not have realized it. Most production is still exported in raw form for processing in Vietnam and India before being shipped all the way back to markets in Europe and the US. Cashew Coast, run by CEO Salma Sitaru, who I'm very pleased to say is with us in the room, is determined to change that. Her company employs 750 people and sources raw cashew nuts from over 7,000 smallholder farmers, soon to double, by processing the cashews at source and shipping a premium product, fully traceable, organic, BRC certified, directly to supermarkets in Europe. The company can pay a higher price to its farmers. And this is what's exciting about this investment, is that Cashew Coast is leading the way in showing how Côte d'Ivoire can build a profitable and socially responsible agri-processing industry, capturing value at source. that industry should shift to Côte d'Ivoire, and it will if companies like Cashew Coast blaze the trail. The second example is from Kenya. This is a recent investment. It picks up on the theme of regenerative agriculture. AgVenture is a cooperative of 10 commercial farms in Kenya, which together supply about 30,000 tons of food, mainly wheat, into the domestic market. The group visited Australia some years ago and saw the benefits of minimum till agriculture, which they brought back to Kenya with great success and are now achieving high yields without irrigation. What's more, AgVenture has established an outgrower program, also offering extension advice for local farmers who grow canola or rapeseed as a rotation crop, which improves soil fertility. AgVenture then buys the canola, processes it into cooking oil, and sells that product, which you can see on the screen, into the Kenyan and regional market. And thirdly, Jacoma, returning to the theme of macadamias. We invested in 2014 into Jacoma, a business in northern Malawi, originally set up to grow jatropha, which failed. Our funds allowed the company to install irrigation on about 500 hectares of land and establish an outgrower scheme to buy chilies, paprika, and macadamia nuts from 4,000 local farmers. The company was later able to attract additional funding, first from BII, and later from a local pension fund. So local private sector money coming into commercial agriculture in Malawi. Jacoma has recently merged with a South African macadamia processor, and together they are now a very significant player in the global market that can compete with producers from Australia. Again, this is about building industries that can last, can be sustainable, can create jobs, and can create a lot of value. So we don't think this should be a debate about big versus small. We should instead focus on mixed models and that combine the very best of modern agriculture with opportunities for smallholder farming communities to participate in formal supply chains. In other words, it's about appropriate scale, which is in fact what Schumacher argued for. Writing in the early 1970s, he said he observed, quote, an almost universal idolatry of giantism, and he wished to correct the balance. But he continued, and this is less well known, if there were a prevailing idolatry of smallness, one would have to try and exercise influence in the opposite direction. So my argument so far has been that agriculture needs to be prioritized to address poverty in the least developed countries. Agriculture is inherently a business activity at any scale, and it needs to be profitable to be sustainable. Furthermore, there's in particular an important role for medium-sized companies, which are embedded in their communities to add value to raw materials and link to markets. So the next question is, where is all this investment going to come from? And this is where we hit a roadblock. If agriculture is a business, it might seem obvious that investment should come from the private sector. And many of us who are economists have been trained that government shouldn't interfere. They certainly shouldn't pick winners. This was the core message of the Washington Consensus policies in the 1980s, which led to African governments pulling back from the agriculture sector, privatizing or closing down state-owned enterprises, and cancelling public extension programs. Closer to home, here in the UK, the CDC Group, which had since the 1950s been investing public money to build commercial agriculture across Asia and Africa, sold off its agriculture portfolio and laid off its many agriculture specialists. And what happened next? Far too little. The private sector didn't come. In most African countries, the agriculture sector stagnated or went into decline. Today, agriculture is only a very small part of DFI and commercial bank portfolios, typically below 5%. despite agriculture accounting for about 30% of GDP in most African countries. That's the halfway point. I'm just going to get a sip of water. The fundamental problem is that on average, African agriculture, especially primary agriculture, is not yet profitable enough to attract private investors in any significant volume. And why is that? Well, firstly, farming in all parts of the world is generally a low margin business, often dependent on family labor. In most developed countries, the sector continues to be heavily subsidized. Around $500 billion per year, according to the OECD, is paid to producers in developed countries every year. To go back to Wales, average farm incomes today are at around £35,000 per year, of which 2/3 comes from subsidies. And if you go to the upland areas where I grew up, sheep and cattle farms are actually loss-making before subsidies. Secondly, in large parts of rural Africa, basic infrastructure, roads, power lines, bulk water is inadequate or sometimes missing. Thirdly, government policies and regulations are often unpredictable and sometimes rent-seeking. Fourthly, and most importantly, I would say, if you are a pioneering firm in a remote area, you're often on your own. You'll probably have to train up a labor force, establish new routes to market. You are unlikely to have a neighbor next door you can go and ask for help or advice. You will probably struggle to get spare parts for machinery, and it would be difficult to find an experienced vet to make a visit to your farm at short notice. All of these factors make investing in African agriculture challenging. As a survey recently conducted by an organization called ASELI shows, this was a survey of 24 banks and non-banking financial institutions in East Africa earlier this year. And you may not be able to read it on the screen, but I'll read out the responses. 84% of respondents said agriculture was riskier than lending to other borrowers. 77% said due diligence was costlier than other sectors. And 69% said the returns were less attractive considering the costs and risks. ASELI found that banks made average profits in their agri portfolios of just 3.2% when they could invest in government treasury bills and earn 10 to 17%. The non-banking financial institutions reported they actually made losses on their agri portfolios. So this is not an easy sector for an investor to enter. I'll give you a quick example of one case where AgDevCo didn't have investment success, and that's a business called AfriOils in Malawi, a peanut company. Peanuts are a smallholder crop, widely known, widely grown, a potential alternative in Malawi to tobacco. The country used to be a major exporter of peanuts in the 1970s and 80s, but that all stopped with the problem of aflatoxin, a mold and a carcinogen, which markets have zero tolerance for these days. Our investment into AfriOils proved that the company could manage the aflatoxin issue and supply nuts into formal value chains in South Africa and Zimbabwe. But demand from those countries proved highly volatile. The local peanut varieties were not suitable for the sort of global export markets, and government policy made it very difficult, if not impossible, to introduce new varieties into Malawi. The final straw for us was that a larger competitor entered the market. Now, that's actually good news for the development of the industry in Malawi, but it wasn't for our investment. So AfriOils is a good example of how pioneering companies often have to absorb the upfront costs and risks of establishing a new business model, but they're not always the ones to get the long-term benefits. So to come on to blended finance, we need a lot more investment in African agriculture if we're serious about reducing poverty and driving economic transformation. but the sector doesn't yet, on average, offer investment returns that are sufficiently attractive to private investors. So this is where blended finance comes into the picture. Blended finance is a type of subsidy which increases returns or reduces risk for investors with the aim of mobilizing private capital into businesses and sectors that can help meet the SDGs. And it can do this in two ways. It can do it directly by combining public and private capital within a fund structure. An example is the Climate Finance Partnership fund promoted by BlackRock, which targets clean energy projects in emerging markets. It's raised about $670 million to date, of which 130 million is capital from charitable foundations and development finance institutions, and 540 million is from private investors. Or blended finance can do it indirectly. And that involves establishing an investment vehicle, which then invests into early stage businesses, providing them with flexible and patient capital to help them overcome some of the hurdles they face as a pioneer. And as those businesses grow and mature, they should be able to attract increasing amounts of private capital. There is a debate within the blended finance community about which approach is best. I won't get into that here, except to say that if you want to catalyze private investments into the most challenging markets and sectors, where the development impact is likely to be highest, you're going to need higher levels of subsidy and more patience. I'll use an example of aquaculture in Africa. Various DFIs and impact investors have supported pioneering investments in Zimbabwe, Zambia, Mozambique, Kenya, and Ghana over the past 15 years or so. After a long period of trial and error, there are now at least 3 emerging players who are profitable and expanding, producing tens of thousands of tons of low-cost protein for local markets and creating jobs for large numbers of market traders, mainly women. We're now seeing private sector feed companies establish factories to supply the fish farms, which in turn is creating markets for smallholder farmers who grow maize and soya. Now, I'm not going to claim that AgDevCo has any role here. We've only been a late arrival to aquaculture, but we have someone from the Gatsby Foundation who's been critical in getting this sector off the ground. Or taking another example, and this is one of AgDevCo's investments. 12 years ago, we invested in greenfield seed potato production in northern Zambia in partnership with a local business. When we started, almost 100% of Zambia's seed potatoes were imported, mainly from South Africa. They were expensive and generally low quality. Today, Zambia is largely self-sufficient in seed potatoes, with benefits for thousands of local potato growers. And we've seen our partner investing downstream in potato processing. Investing in greenfield agriculture is tough. In this case, we'll probably recover our capital, but only just. But the impact is tremendous. It has created opportunities for profitable investments by Zambian farmers and entrepreneurs all along the value chain. So as we've seen, we're a long way from meeting the SDG targets on reducing poverty. Closing the gap would, according to the UN, require an extra $4 trillion per year to meet poverty and climate goals. But total aid flows are only around 250 million. So there's clearly a massive gap. Can blended finance help fill that gap? Well, potentially. Global private assets today are at a record high of about $500 trillion. And if just a small part of that capital could come into responsible businesses in developing countries, it could make a big difference. But unfortunately, blended finance has not yet, so far, lived up to its promise. The cumulative value of blended finance transactions since 2017 has only been around $213 billion, with the majority going to middle-income countries. billions of aid has not so far turned into trillions of investment. So what's gone wrong? Well, one reason is that blended finance structures are nightmarishly complicated. Persuading different capital providers to club together within a legal structure, accepting different risks and returns, can be a bit like herding cats, and the legal fees can become quite high. It's rare to find a new blended finance facility getting off the ground in less than 3 or 4 years. But more fundamentally, the volumes of aid going into blended finance today are simply too low to have a major impact. Less than 2% of the aid budget of ODA is used to support private sector initiatives today. So that's somewhere between $2 billion and $4 billion per year, spread across 140 countries. Now, to put those numbers in perspective, if we can get the next slide. Not sure if I'm controlling this or somebody else is. And just one back, please. To put these numbers in perspective, the US Inflation Reduction Act will direct about $40 billion per year over the next 10 years as grants, tax incentives, and low-cost loans to support clean energy projects in the US, with private corporations as the main beneficiaries. China and the EU are also spending heavily on subsidizing the green transition. So you might say this looks like industrial policy for the rich countries, but only crumbs for the rest. So at a time when aid budgets are under pressure, how can we make the case to channel more scarce resource into blended finance, and especially agriculture? This is controversial. Even with industrial policy becoming more fashionable again, there is still skepticism from both right and left about subsidizing the private sector in developing countries. To try and win over some of the skeptics, we need to gather the evidence, point to what's working, and focus on value for money. Rory Stewart, who many of you will know from his podcast with Alistair Campbell, the former International Development Minister, recently appeared in front of the UK's International Development Committee. He now represents the charity Give Directly. Give Directly raises about $300 million per year from donors and uses mobile money to distribute small cash grants directly to poor households. Now, a growing body of empirical research suggests this is a highly effective and efficient way of reducing poverty. Effective because cash stimulates economic activity and trade, and efficient because you don't need a giant bureaucracy and the overheads of a large donor agency to distribute that cash. And he in fact said, Stuart, that if he was Secretary of State again, he would consider allocating the majority of the UK aid budget in this way. So I think it's worth considering how the value for money of giving cash directly compares to blended finance for agriculture. As it happens, $300 million is roughly the size of AgDevCo today. And last year, as you can see in our annual report, we measured that the companies in our portfolio injected about $500 million directly into households in rural communities through wages for employees and payments to small farmers. And it's likely those companies will continue to do that year after year, even if AgDevCo made no further investments. Overall, that looks like pretty good bang for your buck. Of course, there's no one-size-fits-all solution for development, but I would argue there is a strong case to be made for a higher share of aid and philanthropy to be allocated to blended finance in African agriculture, because if you get it right, it is probably one of the best ways of reducing rural poverty in terms of value for money. Lastly, I come to ways of supporting the next generation of agri entrepreneurs in Africa. When AgDevCo started back in 2009, we had limited capital to invest, and we made some very small investments, sometimes as low as $100,000 or $200,000. It was exciting and pioneering, but we lost money. We certainly made mistakes in those early days. We did, however, help launch a number of businesses that have grown over the past decade and now are benefiting tens of thousands of local farmers. And there's one on the screen, which is East Africa Foods, led by Elia Timotheo, an agro-logistics firm in Tanzania, which is now roughly a $20 million turnover business, connecting small farmers to local and regional markets. So we achieved a lot of impact in those early days, but we did lose money because investing in a portfolio of small companies is especially difficult. All of the constraints I described earlier apply, and you have the challenge of high transaction costs to make and manage small investments. And so from around 2017, we started rebalancing our portfolio by adding larger investments with more established companies. And as a result, we are delivering more impact today, and we've also moved to profitability. But we have been criticized by some for taking less risk and being unable to support those small startup businesses. And when Sir Keith retired from the AgDevCo board just over a year ago, he said at his leaving dinner that he wanted to see AgDevCo first achieve sustainability, but then get back into doing small investments, which is central to our DNA. So we're really pleased to be able to announce today that we have the support of the UK government to launch a new facility called AgDevCo Ventures. It will be a $50 million blended finance facility for small early stage investments of up to $3 million, with the aim of building the next generation of African agribusinesses. It will invest in a high proportion of African and female-owned or managed agri-SMEs. The UK government is providing $25 million of equity funding, and we expect to raise the matching $25 million from DFIs and philanthropic funders. And you should have a press release on your chairs. So, in conclusion, we are falling well short against the SDGs, especially in sub-Saharan Africa, where uniquely the numbers in extreme poverty are not falling. Investment in agriculture is highly effective in reducing poverty, in particular when you invest in medium-sized firms with inclusive business models. Although, as a book title, Medium is Beautiful doesn't have quite the same ring to it, but it's what we believe. The challenge is that African agriculture in most countries, on average, cannot yet provide the level of returns sufficient to attract private capital in large volumes. Blended finance offers a solution. It can be used to help launch pioneering companies, catalyze the development of new industries, and build the next generation of locally owned firms. Done well, blended finance for agriculture could be one of the most effective and efficient ways of using aid to tackle poverty and help economies develop. Will blended finance become a much bigger part of the international development system over the coming years? Or will it remain a niche corner of aid which promises much but under-delivers? I hope I've persuaded you that there is a good case for doing more of it, especially in agriculture. But to change hearts and minds, we'll need more stories of world-beating businesses like Hatch Africa, like Cashew Coast, and how they're delivering impact at scale. I'll stop there. Thank you very much for coming. Thank you for your attention. It's appreciated.